Hey everyone, and welcome to Data Driven Value, where we show you the tools and teach you the skills to help you take your financial freedom into your own hands. So today I want to talk about a really important topic. I want to talk about security. So when we take our investments into our own hands, we are taking on a degree of responsibility in terms of security, especially when it comes to Bitcoin and crypto. I'm going to kind of talk about different ways we can help mitigate that risk and also what is prompting this video. So we did have kind of something happen on Friday here. We had the largest single hack in Bitcoin or crypto history here. We've seen $1.46 billion of Ethereum stolen from ByBit. That's one of the leading cryptocurrency exchanges. We see here they didn't essentially break the code, although they did alter it, but in a way that was just kind of tricked all the people into approving what they thought was just a routine transfer. So I'm kind of going to get into this scenario here. We're going to look at the individual platforms that I personally use for investing, what kind of insurance policies we have protecting our assets, as well as looking at other alternative ways we can store our own assets in terms of Bitcoin and crypto. I'll talk about hardware versus hardware versus hot wallet, so a cold versus a hot wallet. We'll get into that, but for now, I kind of just want to give you a bit of context about what happened here and why no one is truly safe. So that's kind of a big important factor here. It's different in terms of investing, and because a lot of companies are regulated by traditional financial standards. So we'll break that down. When you get into Bitcoin and crypto specific companies, the regulations are kind of a little bit looser. So you want to ensure that any platform that you're utilizing has some sort of insurance policy to cover this kind of thing from happening, protect yourself, your assets. So we see here Lazarus, that's a state-backed North Korean hacking group responsible for stealing billions from banks, crypto exchanges, DeFi protocols, and they just pulled off the biggest crypto heist in history, taking that $1.46 billion from ByBit. Essentially no code exploit. They didn't leak the private keys. ByBit had a multi-signature signing process in place. So essentially they had a bunch of different people that all needed to sign off on every transaction for it to be approved. If one of those signatures didn't agree, then that transfer would not take place. It would be denied. So we saw here, they essentially thought they were signing a routine transfer, but instead there was actually underlying code that kind of altered the permissions of their wallet and handed over control to a different entity here. Scrolling down, so raising the question, how did they know who to target? Obviously, as I mentioned, a multi-sig wallet requires multiple signers. That's supposed to increase the amount of security that it does provide. If one person refused to sign, the hack would fail. So everyone signed, which means they didn't just hack ByBit. They knew exactly who to manipulate. So we do see here there's a few different ways to get this information. Either an inside job, so someone who knows something was leaking details to someone else. It is known that sometimes these hacker groups put people in place of what, so they'll get hired into a company and like on a job position, but these are actually undercover hackers just looking to gain additional information. So we also see they could have used social engineering, so studying emails and different behavior, or kind of a device compromise is the other one. So one of the signers could have been infected with malware, and then they were able to kind of get this information through one of these avenues here. But that also means that other exchanges are at risk too, just because if they were able to do this with ByBit, such a large exchange, who's to say what information they have on other exchanges as well. So we need to be aware of what's going on. We do see here kind of the social engineering attack cycle. They gather information, they establish a relationship, they do the exploit, and then they execute it right here. So that could be what happened through here. They did manage to steal 0.42% of all Ethereum, so that's a very significant amount. As I said, $1.46 billion, more than the Ethereum Foundation, more than the creator of Ethereum, and more than every financial asset manager that's involved in Ethereum. So this is the largest hack in history, and they do have a substantial amount of Ethereum now. In previous attacks, they reused bridges to other blockchains, mixing services, as well as illicit over-the-counter trading. So they do have ways to launder this money without kind of going through the traditional avenues. So luckily, though, because Bitcoin and crypto is so easily traceable, we saw that investigators quickly flagged 53 wallets holding the stolen ETH, and then they're not in a hurry to cash out either. So just because that they've found the wallets holding this ETH doesn't mean that it's going to be recovered. And North Korea does not have a good track record of returning stolen funds. They typically use stolen illicit money to fund other kind of military kind of expenses, that kind of thing, building out their nuclear facilities. So this could have some major implications here. It's why I'm just kind of letting things play out, see what happens. I'm not getting too crazy. I'm not going to just go start buying Ethereum because it dropped a few $100s. Like, this is a major hack, and I'm not fully aware of all the implications that could arise because of it, and I don't want to take any extensive risk without knowing more details. So we'll scroll down a little bit more. We see here in 2022 Chainalysis, so this is on-chain trackers here, they found that Lazarus still held $55 million from hacks that occurred 6 years earlier. So yeah, they're not in a rush to get rid of this money. They're gonna launder it, and then so over time they'll just continue laundering it through the avenues that they see fit. They don't negotiate, they don't return funds. We see here, ByBit CEO addressed the crisis publicly, saying client funds are one-to-one backed. They have enough liquidity to cover withdrawals. So that being said, they did have to take loans from other companies to cover the withdrawals. There was a massive amount of people that were spooked by this and wanted to pull their funds off that exchange. They were able to satisfy all those withdrawals, but they did have to take loans from other companies. So they said they have enough liquidity. That being said, they had to borrow liquidity. So that's kind of raises a red flag in the back of my mind. If everything's one-to-one backed and you have enough liquidity to cover withdrawals, why do you have to borrow so much money from other companies? We kind of saw that during last cycle in the FTX implosion. We saw certain bankrupt companies having to borrow money from other more successful exchanges just to remain solvent. They did say all their other wallets remain secure. That being said, if I was in ByBit, I would just pull my funds out preemptively. I'm not taking that existential risk. I've been here long enough. I've seen enough of these exchanges crash and fail to know not to really trust them too much. That's why I'm a big proponent of self-custody, at least as much as you can. I understand there's times where it might not make sense, and I'm going to talk about options for you if you can't do self-custody yourself, but it's not the first time it's happened, and it won't be the last. So just looking here, this thread just has a couple ideas on how we can remain safe. Cold wallets stay cold. So yeah, making sure that if we do use a hardware wallet that we're not connecting it to an internet source, and then never sign blind. This could have been prevented if all the signatures just looked at the underlying smart contract. So just because the user interface looks right and the address looked right, that's how the hackers were able to do it. They essentially used what's called a musked transaction. So it displayed a normal address, the address that looked like it was from their wallet provider, but the underlying smart contract code actually handed over that control to the hacker. So if they had just verified the smart contract code, they could have avoided this entirely. That's kind of why I think it's a big blunder on ByBit's part. I wouldn't trust ByBit myself personally. I know a lot of people probably have conflicting views. They are actually pretty impressed about how ByBit handled the whole situation, and it is impressive that they were able to keep withdrawals open, not pause them, and satisfy all those withdrawals. That being said, it is ByBit's management's fault, in my opinion. This never should have happened. They should have verified. So I'm not forgiving them. I'm not forgetting, and it's just further kind of cementing in the back of my mind that either self-custody if you can do it, otherwise you may have to look at other more safe alternative platforms to kind of custody your Bitcoin and crypto. That being said, the exchanges that I use or that are available to us in Canada, they're generally safer. So a rule of thumb for me, if an exchange is offering cheap, low fee futures trading, margin trading, leverage trading, it's generally going to be a sketchier exchange because they make their money through they have to make their money some way. So if they're offering very low fee trading, they have to make their money elsewhere, and that's where there's not a lot of transparency in these companies, and you really need to, it's kind of like a trust me thing. So here, ByBit in charge of custodying lots of money for other people, and they handed away $1.5 billion worth. So the platforms that I use, they have an insurance policy. They don't offer these kind of sketchier, higher volatility, really risky avenues of investing, and they generally have they earn their revenue from fees rather than earning their revenue through other activities. Who knows what they really are. In the prior cycle, we saw exchanges actually taking user funds and actively trading with them. So yeah, it's hard to say what's going on behind the scenes. So we want to be sure that we're going to mitigate as much risk as possible. So I want to dive into all the different platforms that I use and I recommend. We're going to talk about Wealthsimple first. So this is Wealthsimple, essentially offers both investment in terms of traditional stocks as well as crypto services. So they do have various forms of coverage as well as insurance. Wealthsimple investing clients and their affiliated custodial broker is a member of the CIRO, and customer accounts are protected by the CIPF within specified limits. We'll learn more about that right here. So basically, if you're in Wealthsimple, in an investment account, you have up to $1 million for all general accounts, you have up to $1 million for all registered retirement accounts, and you have up to $1 million for all registered education savings plans. So this is the coverage you have protecting your assets in Wealthsimple in terms of kind of stocks and that kind of thing. So we'll also just flip back here. We see they hold, so we take a look at crypto. Crypto is slightly different. Wealthsimple, I do, just the fact that they have that CIRO and CIPF regulation up here, it just makes it a little bit more enticing for me from a safety standpoint, alternatively to some of the other platforms. So we do see here they hold their crypto in trust. Your crypto is protected. The property held in trust is protected from claims by creditors. They hold the majority of client assets with regulated third-party custodians, and they have appropriate insurance and sufficient capital to kind of prevent that the loss of funds there. The cash balance is held within customer accounts is protected by the Canadian Investor Protection Fund, or the CIPF. So your cash is protected by this CIPF regulation, and your crypto is protected by the insurance and capital of the custodian. So we do see here cash balances over 100,000. We see their clients' cash account balances over 100,000 Canadian in trust with multiple members of the CDIC, which allows extension of coverage in your account to up to $1 million. So what they do essentially is they have a bunch of different coverage with various banks in Canada, totaling up to $1 million, and it just spreads that kind of counterparty risk out across a bunch of different entities. I mean, these are all federally regulated Canadian banks, so they're relative, like the safest it can kind of get, in my opinion. You know, I have no problem having a lot of money on Wealthsimple. It's where I manage my TFSA as well as my non-registered trading accounts, and it's a good place to, it's got a good all-in-one platform if you're looking for somewhere to invest in stocks and crypto, and kind of as well just making sure you do have that additional coverage as well as protection from kind of the better regulatory bodies here. We'll flip over here, looking at ShakePay. So ShakePay is another one that I do recommend. It's really good. I actually really like their insurance policy, just looking at it from here. Cold storage. So the vast majority of digital currencies held at ShakePay are stored in offline cold storage. They do have a percentage that they will kind of move to. They need to have liquid to kind of satisfy the buys and sells of customers. So at least 80% is going to be held in cold storage, and then 20% will be kind of liquid assets to cover incoming and outgoing withdrawals and deposits. We see they hold an insurance policy on their digital currencies held in cold storage, which covers damages, theft, loss of private keys, keys. They have that multi-party approval, so that multi-sig requirement that we talked about. Segregated accounts, so they hold our Canadian dollars in segregated Canadian bank accounts, which are federally regulated. And digital currencies are stored in segregated cold storage wallets. Also, no fractional reserve, meaning all of the assets are backed 1-to-1. Your money is always there. They don't do anything. They don't do anything with it. They don't trade it. They don't move it around. It's just held there. And again, they make their money off of fees. They also have strict whitelisting. So just ways to kind of prevent, illicit actors from withdrawing to other sources that haven't been approved previously. Flip over here. We also saw recently in January, they're now CIRO regulated. So that's really good to see, as we talked about more protection for your cash, up to $1 million per customer, and your money is held 1-to-1 with approved custodians, kept separate from operational funds. So great to see that from ShakePay. Moving down here, we can also just break into the custodial agreements to kind of see what the logistics are behind it. So the vast majority of assets held at ShakePay stored in offline cold wallets, minimum of 80%. So that can be more, but they just maintain a minimum of 80%. So even in the event that something just catastrophic happened, 80% of your crypto would be secured for sure, as well as the additional amount that was held in that hot wallet or kind of the liquid assets. So really good coverage for kind of a Bitcoin or crypto related entity here. They do hold this with Coinbase Custody Trust, or Coinbase Custody, which is a U.S. qualified custodian. Coinbase is also the custodian for all of the major ETFs, so they are the best custodian in the game there is right now. So I feel good having them as the custodian for ShakePay. For the benefit of FBO accounts owned by you, means you have the legal and right to claim these assets. So no one else has that legal right except for you. And the remaining crypto assets purchased by customers are held by ShakePay using multi-signature hot wallets. So that remaining up to 20%, it might be less. They do hold those in hot wallets secured by Fireblocks and BitGo. So it's just interesting to see. Break down who the actual custodians are. Fireblocks, a really reputable company. Coinbase, a very, very reputable company. One of the biggest exchange in crypto right now. And as I said, they are the major partner and custodian for all of the ETFs. They've essentially kind of facilitated tens of billions of dollars worth of inflows into those ETFs. So yeah, feel really good having Coinbase as the custodian for both ShakePay as well as Newton here. We're going to talk about that. So Newton has similar kind of practices with that 80-20 cold storage, so minimum 80% in cold storage and then 20% to satisfy those incoming withdrawals or deposits. They insure their assets, so various forms of insurance for crypto assets to cover risk of loss or theft from our wallets, and institutional grade storage. So we're going to break this down a little bit more. Looking here at the logistics, 80% held in custody. Again, Coinbase Custody Trust. So good to see Coinbase. And then 20% here, secured by Fireblocks. So similar to ShakePay there, using Coinbase and Fireblocks as two custodians. We see here it has maintained a $320 million insurance policy, which covers the losses of assets held by the custodian on behalf of its customers due to hacks, copying, or theft of private keys, insider theft, or dishonest acts. So up to $320 million US of coverage there. The custodian holds all client assets in trust for clients of Newton in a fully segregated account in the name of Newton, and separate and distinct from the assets of Newton affiliates and all of custodian's other clients. So that's kind of the difference between ShakePay and Newton. Is Newton, the assets technically kind of belong to them in terms of the agreement here, whereas ShakePay, you're the one who has the legal right to those assets. So ShakePay looks a little bit safer from kind of just a standpoint here. So if we were looking, if you wanted to just, if you're in Canada, you want to buy Bitcoin and Ethereum, you might be looking at ShakePay as a really good option. Wealthsimple as well, also a very good option. I would say Wealthsimple first, followed by ShakePay. Newton here, a little riskier, still looks pretty good, but it also gives you more options. So Newton has a lot of different cryptocurrencies you can invest in. But kind of with more optionality comes a little bit more risk, it would seem. If the custodian, basically it says protects us if the custodian were to become bankrupt or insolvent. Your assets may be subject to risk of loss. So that's where I really really kind of prefer the shake pay agreement here, is that you have the legal right to those assets. So if you're buying stuff on buying stuff on Newton, you know, generally looking to kind of move it into your own self-custody, or if you can move it into another platform, or simply just use the platform like Wealthsimple or ShakePay that kind of offers the higher security measures if you don't want to go the self-custody route. We do see here the custodian's system of controls and supervision is sufficient to manage risks of loss and prudent with business practice. Newton controls online hot wallets, so there is that risk that they could lose those, in which case they would be liable to us under the terms and conditions that we've signed. They do have an insurance coverage in the amount up to $30 million in the event of crypto assets being stolen or lost. They've also licensed software from Digital Asset Services Limited to provide additional security for these keys. Backup key material for Newton's hot wallets is secured by CoinCover and 100% guaranteed against loss or theft. So it's a decent little coverage here for Newton, but as I mentioned, ShakePay has better coverage and Wealthsimple is the best of the three, in my opinion. I mean, I use all three for different reasons, but I do like to self-custody as much as I can, or just holding it in the safer platform like Wealthsimple is another alternative option there. Coinbase, another one. So Coinbase is the custodian for these other platforms. It's another exchange that I use. I do recommend it. It's a really great exchange. Fees can be a little bit more expensive, but sometimes I opt to pay a little bit more for fees, knowing that my exchanges aren't engaging in kind of nefarious activities with the assets or the money. We do see here other operating subsidiaries covered by Coinbase Global's crime insurance, protecting a portion of its digital assets held across storage systems from theft and cybersecurity breaches. It does not cover losses from unauthorized access to your personal account. So probably similar to Newton and ShakePay, if you give away your password to your account and you've got assets in there, that's not their fault. That's technically your fault. There's lots of ways you can prevent this. So choosing a really good password, using two-factor authentication, as well as you can also set like whitelists and blacklists for withdrawal addresses. So making sure that you're just using as much of the available security measures as possible to really secure your account. Same as a bank, you just want to be sure, it's really hard to get into. You want to have that two-factor authentication as well as a way to confirm every single transaction. So either an email confirmation is what you're going to be looking for, or something kind of similar there. We're going to flip over here. They also have $255 million of crypto insurance coverage. So we do see, we'll just scroll down, it is covered, Coinbase here, for up to $255 million of coins held in the hot wallets. So they do have some coverage of the cold storage wallets, and they have a lot of coverage of these hot storage wallets, which they argue is more potentially open to hacks. So Coinbase holds less than 2% of customers' assets in hot wallets. 98% are in cold storage wallets, so less likely for those third-party attacks. But just moving on, we're talking about a hot versus a cold wallet, so you might have no idea what I'm talking about, so I want to get into that now. If you're into crypto and Bitcoin and you want to kind of continue getting into it, you're going to really need to figure out hot wallets and cold wallets. I use a combination of the two. That being said, I use the majority cold storage wallets when I can, and then I use my hot wallets for kind of day-to-day transactions. But in terms of substantial value, you want to be ensuring that you're either cold storage custodying, or you can use a different avenue. I'll kind of get into that after we break down this. So hot wallets are software based, typically connected to the internet and used for regular transactions. Cold wallets are hardware based, offline, used for secure long-term storage of cryptocurrencies. So understanding hot wallets. Hot wallet, known as a software wallet, typically connected to the internet, is a piece of software installed on devices like smartphones or laptops. It generates your seed phrase. So your seed phrase is 12 to 24 words. That is the password to your account, or to your assets. And if you have that seed phrase, you can essentially recover that wallet on any single platform. So the seed phrase is the most important thing to secure. You don't want anybody else knowing that. So it generates your seed phrase. It does this online and stores the private keys online too. It is more straightforward and convenient, but it comes with more risk because you risk that kind of third-party connection there where a hacker is able to kind of take advantage of it. So if you're in crypto and Bitcoin, definitely recommend using a VPN, even just a free VPN. Like, something is better than nothing. Protect your location as well. You see here, the online nature of hot wallets is what presents that security concern. Once your seed phrase and private keys have been online, there's no way of really knowing if they're still secret, if your computer is infected with some sort of malware or virus. So that is the risk that comes with hot wallets. And then, so we'll talk about cold wallets, which is a crypto wallet not connected to the internet, often a physical device, stores your private keys and the seed phrase offline, making the wallet less vulnerable to online attacks and a higher level of security. However, the offline nature also makes them less convenient for regular transactions because you'd often need to connect your cold storage wallet to an online device and then making that transfer then and confirming it on the actual physical device. If you don't have it, then you're not going to be able to confirm that transaction. Hot wallets being typically connected to the internet offer ease of use and accessibility, whereas cold wallets being offline offer that higher level of security, less vulnerable to online attacks. And choosing between the two is going to be a choice of preference here. So your individual needs. As I said, I like to combine hot and cold wallets. A hot wallet can be used for regular transactions and small amounts of cryptocurrencies, and a cold wallet for storing larger amounts of cryptocurrencies for the long term. So things like Bitcoin and Ethereum, putting those away over a long period of time, I want to have those in my cold storage, but I might use a hot wallet just for kind of day-to-day transactions. If I'm buying smaller amounts, then the hot wallet does work as well too. There are a bunch of different options we can look at. So in terms of cold storage wallets, I'm going to show you a couple here. The Trezor, I have one of these. I use Trezor, I've used Ledger. I prefer Trezor. So right here you can see for $50 US, so $70 Canadian, you can buy a hardware wallet, a cold storage wallet, and really get that added security. So I kind of argue if you're going to invest money into Bitcoin and you're interested in self-custody, if you get over that kind of $100 mark of worth of Bitcoin, start looking at a cold storage wallet, because if you're going to continue acquiring Bitcoin over a long period of time, you're going to want to have the most secure storage for that available. So, maybe if you get to $100, you don't buy one of these yet, but maybe you're planning to put $1,000 into Bitcoin. For $50, that's really a small amount to get that added security. And one of these is going to be good for life, basically. It's always going to be good for you. And so you just continue storing your Bitcoin here long term. Alternatively, you can there's all different kinds of options. So there's the Cold Card. This is another one, really great hardware wallet, one of the most secure. It's true air gapped, so fully air gapped. It's never connected to a computer for its full life cycle. Open source code, that's really important. That being said, these are quite a bit more expensive, so for over 3 times the price essentially. But if you're a really big Bitcoiner, then you might opt for that additional security. That being said, the Trezor is going to be perfect for most people's needs, and it's very cheap. The base model just at $50 US right here. So I would highly recommend, if you want to get into self-custody of your own Bitcoin or assets, looking at something like this. And then I'm going to talk about some hot wallets that are available to you. So Coinbase wallet here. Essentially, this is a hot wallet. It's developed by Coinbase, but you are the one that has custody of it. They don't have any permissions here. It's just the interface of the wallet. This is probably the one I would recommend most people if they want to get into kind of their own hot wallet storage. The Coinbase wallet going to be the best, kind of the simplest user interface. There's also MetaMask here. MetaMask, the more experienced one. It's been around a lot longer. That being said, the user interface is a little bit more difficult. So for new people in the space, you might just prefer the Coinbase wallet here. And then if you are into things like Solana or Base or other coins, you might look at Phantom wallet. So this is one, it's kind of the biggest Solana wallet. So if you're into that kind of cryptocurrency, then definitely check out Phantom. I really like this wallet. I use Phantom. I have MetaMask, but I don't use it very much. I have a Coinbase wallet. That's probably the one I use the most in terms of hot wallet. So Coinbase wallet, Phantom wallet, and my Trezor is kind of what I can use to custody a lot of the different assets. That being said, so I'm also going to talk, if you don't want to self-custody, there are ways to still gain exposure to Bitcoin and crypto. That's going to be through ETFs. So that's where you're going to use the platform Wealthsimple. Essentially, different financial advisors, or sorry, different financial entities are offering exposure to Bitcoin and crypto via ETFs or exchange-traded funds. These are pretty new. They've just launched in the US. They've been in Canada for a few years now, but essentially these funds just track the price appreciation or kind of decline of Bitcoin and Ethereum. So there's a Bitcoin ETF and an Ethereum ETF. And yeah, if you want to just hold, if you're just interested in the price appreciation aspect of Bitcoin or crypto, you don't want to handle any of the custody problems, the security problems, then definitely look at Wealthsimple and look at the ETFs as a great way to gain exposure. You can also hold them in tax incentivized accounts like TFSAs as well. So there is kind of different kind of incentives to holding the ETF as opposed to self-custodying. It really depends what your preferences are. But it is a good option if you don't want to deal with the stress of self-custody, you don't want to deal with the security, you don't want to kind of sign up for all these different platforms. Just going with Wealthsimple and choosing that ETF option is going to give you that exposure without having you kind of take on the responsibility of the security and the risk. So that's kind of all it is for today. It's a little bit of a long video. I know there's a lot of different things to cover, but I wanted to break down all of these different platforms, as well as kind of the insurance and policies that we have covering us and different ways we can look to really mitigate that risk, because security is a very major concept to master when it comes to especially Bitcoin and crypto. And hopefully the information that I've shared with you today will help you just mitigate some of that risk. And